What's going on, everyone? Gilman with Wellthy Stocks, back with another video, and today it's not looking at a stock. Rather, we're going to be discussing an option strategy that I like using, and it's relatively simple. And I know a lot of you guys have asked me, hey, could you share some option strategies that you've used? And so what I'm going to do today is I'm going to be talking about a strategy that I like using. It's called a cash secured put. Essentially the way it works is, let's say you want to buy a share, you have enough money to buy 100 shares of a company, but you only want to buy it when it dips to a certain level. You could do what's called a cash secured put, get a little bit of premium for the wait that you are, or for waiting pretty much, right? And you could end up with the shares, or you could end up getting to keep the money that you received in exchange for promising to buy those 100 shares at a certain price. So if that was a little bit confusing and you have no idea what I'm talking about, no worries. We'll dig right in. I will do some examples as we always do, and then we will talk about, any questions that you guys have down in the comment section, or I'm going to show you guys an exact example of how I do it to kind of either A, make some money if I don't think a stock's going to dip below that, or if I want to buy a stock, instead of going out and buying the stock, right, or sitting around waiting for the stock, I can sell this put to get a little bit of money and, wait for kind of the price to come to me, if you will. So real quick, if you enjoy my videos and you enjoy my channel, don't forget to hit that like button down below. Subscribe to my channel if you are new. Comment down below what your thoughts on cash secured puts are, if you've used them, if you're still confused, and I'd love to chat with you guys down in the comment section. So I'm gonna go ahead and hit record on my computer and we will get right into it. So for this example, what I have pulled up here, you guys, is Solo Stock Electromechanica Vehicles Corp. I've made videos on it in the past. They make an electric vehicle that is a one-person vehicle. I like the company, but what I'm concerned about is, hey, is there even a market for this, right? So currently they're trading at 727, and I'm going to take a look at the 5-day chart to kind of give you guys an example, right? So they were trading in the 8s and they went to the 7s. I don't know if I want to buy it at the 7s, right? Let's say I'm interested in the company if it goes to $6. And for me to buy 100 shares of this company now, I need $600, right? So if I want to buy 100 and I want to buy it at $6, what I need is $600 in my brokerage account, right? To be able to buy these $6 puts, or excuse me, this $6 stock, if it ever comes to 600. Let me bring in my Tastyworks now for just a second, and I'm gonna walk you guys through, how to do that. So let's say I go to Solo, and I wanna go to March, and I wanna say, so ignore these, this is my open positions currently on Solo. But let's say I go, okay, you know what, I want to, so I guess $6 is a strike price, right? I was hoping there'd be a 7, but for this example, we could use 6. So what I could do is I could go ahead and sell a $6 put. And what that's going to do is I'm pretty much saying I am willing to buy Solo shares at $6 no matter what. So you're pretty much, insuring someone. Let's say if Solo stays above 6, right, you don't have to buy anything because obviously you've promised to buy it at 6. So if it's at 650, you don't have to buy anything. If it's below 6, right, that's kind of where, if it's below 6 by 47 cents or less, you come out ahead. If it's below 6 by more than 47 cents, that's when you, potentially have the chance of losing money. So I want to kind of go over this real quick. So if you have, let's say, those $600, right, what you could do is you could go out and say, hey, I am willing to put this on, right? I'm willing to put that $600 aside in case by March 19th, Solo falls below $6. And in exchange of doing that, you get 48 cents in credit, which that times 100 is $48. So essentially what you're doing is, the way I like to think about it is, you're getting paid for waiting for a stock to come to your price, right? So there's now 3 things that could sort of happen. Okay, so I've got a little Excel sheet for us to kind of go through and talk about the different scenarios that could play out, right? So there's 3 things that could happen to Solo's price between now and March 19th, which is, you know, the one I'm buying. You could go out and you can even, I mean, you don't have to buy March 19th. You could even buy, you know, next Friday's $6, but obviously it's not worth anything. If you buy next week's $7, right, you could get $27. And so on and so forth, right? So you could do this on a weekly basis. You could do this on a monthly basis, whatever it wants. Actually, let's switch the example. So instead of saying I'm going to buy a $6 put, right? I'm going to buy a $7 one because I think that that's a little bit more realistic. It's trading at $7.27 right now. So maybe I actually do want to buy Solo shares. So what I'm going to do is I'm going to go ahead and sell this put for 84 cents credit, right? That's what it says here. That's the midpoint between the bid and the ask. So what happens is I need $7, right? $7 per share, so $700 minus whatever I'm getting here. So I would need, I mean, depending on your brokerage, you might need the full 700, you might need a little bit less than 700. Here, in my case, I need $621 to put this trade on because basically what they're doing is they're making sure that if it does fall below the $7 mark, I have enough money to be able to buy 100 shares, right? So now 3 things can happen to Solo stock, okay? So right now you see Solo was, so this is 220, February 20, and the price of Solo share is current price is $7.27, right? There's 3 things that could happen, okay? Solo go up, Solo go down, and Solo stay flat, okay? So as of February, so what I want to talk about is the 3 different scenarios and how each of those scenarios help you, because I think that that kind of helps you see whether or not this is a good strategy for you, right? So today, if I go out February 20, March 12th is when you're promising to buy for $7, right? Promise to buy Solo for 7. And you get, what was it, $84, right? Yeah, 84 right there. It says 84 cents, but that's per, so you get $84. Now, if Solo were to go up, it's at $7.27 right now. If Solo were to go to $8, $9, $10, right? Never get Solo shares. I'm gonna type Solo in capital. Get to keep the $84. If Solo goes down, actually let's talk about Solo staying flat for a second, and then I'm going to talk about Solo going down. If Solo stays flat, you never, again, I'm going to copy paste this, because if Solo is at $7.27, someone can go out in the open market and get $7.27 for their shares. Therefore, they don't need to sell it to you for $7, right? It'd be silly for them to do it for $7. So now, if Solo were to go down, how does this impact you? There's 2 scenarios that, actually no, I'm going to talk about 2 scenarios. So I'm going to talk about assuming it goes below 7, okay? If it's between $7 and $7.27, right, then we don't care, right? Because you're not going to get the shares. If Solo were to go down, if below $7, right, and again, it can go up and down and up and down. We're more focused on March 12th. That's the expiration date that we've chosen. So that's what we're more concerned with here, right? It could get exercised, meaning you could be given Solo shares if it goes below 7, but typically people will only exercise it at the expiration date. So if below 7, right, remember that you've already gotten $84, right? And that's something you've gotten no matter what. So if it goes below 7, right, you've gotten 84 cents. So between $6.16 and 7, you make the difference, right? Below $6.16, you lose money. Okay? So what do I mean by this? You pretty much, okay, so you would spend $700 to buy 100 shares, right? Because you've promised to buy them at $7 a share. You've gotten 84 cents. So 700 minus 84 equals 700 minus 84. That's where I'm getting this $616, and then you have 100, so each cost is $6.16, right? So if it's between 616 and 7, if it's at $6.50, your cost is 616, so you could get those shares, sell them at 650. However, if Solo dies and goes to $5, you still have to buy the shares at $7. Your cost on those shares is technically $6.16, and now you're stuck holding the shares for $6.16 that you can't get more than $5 for currently. I mean, obviously you could hold them and they'll go up in value and stuff like that, right? But so I hope this hasn't been super confusing, but there's three things that could happen again. So Solo shares, again, by March 12th, since you're promising to buy it at 7, if Solo stays at or above $7, you get to keep the $84 that you're getting here, okay? So you put in, I mean, in my case, I'm putting up 621 bucks, and I get to make $84 in a matter of 3 weeks. So that's like 12-13% on my money in a matter of 3 weeks. That's if Solo is at or above $7 by March 12th. If Solo were to go down, again, if it goes down from 727 to 7, same deal, right? I don't get assigned. If it goes below 7, that's when I'm kind of eating into some of this credit that I got, right? And below $6.16, right? Because 700 minus this 84 you got, that's when you start losing money. So if you think Solo is going to stay above $7, this is a good strategy. If you think Solo is going to stay above $6.16, it's a great strategy. If you are willing to buy Solo at $7, by doing this strategy, you could pretty much lower your cost to $6.16. Because if you were to get assigned, you had gotten $84, so you're giving $700, but you've gotten $84, so you're really paying $616. Where this strategy might not be the best to get returns is if Solo runs, right? So if you were to get in Solo $727 for 100 shares today, and Solo runs to $10, right? You get the difference. So you've put in 727. If it runs to $10, your 100 shares are worth $1,000. So you get to sell them for $1,000, and your cost is 727. So you get the difference. You get to make more than like 270 bucks. But in this case, if Solo were to run to 10, the max amount you could make is $84. But that's, I mean, you're putting up 621 rather than 727. So the reason I like this is, hey, if there's a company that I'm interested in and I think that, you know, I want to buy this company on a pullback, I don't know if there is a pullback, and I'm not, you know, crazy about the upside in the company, right? Like Solo is one of those companies where, I mean, I think the stock has potential to run into, you know, 7s, 8s, 9s, right? I think it's going to struggle to break 9s because that's what it's done recently. So if I'm willing to buy it at 7 rather than sit around and wait for it to come to 7, might as well, and if I already got the money, might as well, you know, put this 600 to work, make 84 bucks in the next couple of weeks. Worst case, if it falls, I get assigned. Best case, I get to keep the 84 bucks. Where I don't like the strategy, though, is in case like Palantir is a great example, right? If I go to Palantir and look at the same chain, right? Same March 12th chain. Actually, let's look at March 19th because that's a monthly chain, right? It closed at $29. I could sell a 27 put, meaning if I'm willing to buy Palantir at $27, I could sell this. I get 260 bucks for it, and I'm promising to buy 100 shares of Palantir at 27. So technically $2,700 is what I would need to spend, right? And I'm getting 260 bucks. So if But the reason I don't want to do this on Palantir, even though this could be a really good deal if Palantir doesn't go to 27, is because I want the upside, right? So I just mentioned in the Solo example, if Solo runs from 7 to 10, I don't make 100 shares worth of money. I only make the $84. Similarly here, if Palantir runs from 29 to 40 bucks, right? Which, I mean, I don't know if it will in the next couple of weeks, but it does run a lot. So, but my profit is capped at 260 bucks. If I had 100 shares and spent $2,700 and it went to 40, I could sell it for $4,000 and I make $1,300. But here I'd only make $2.60. So for me, it's more for, you know, stocks that I want to buy, but not necessarily dying to own just yet. I'm waiting for the right price. I've got the money. Or if I simply think that, you know, Solo is not going to dip below 7, or even if it dips below 7, I don't think it's going to stay below $7 by March 12th. This would be a good strategy because I get to, again, put up 621 bucks to make $84. So I hope that this was helpful. I'm just trying to show you guys different ways that I personally like trading. Buying and selling stock is a very, very, very small part of what I do on a daily basis. I do a lot of different strategies. This is one of them. I've talked about covered calls in my videos, and vertical put spread is by far my favorite thing to do. I'll make a video on that soon as well for you guys. But let me know down in the comment section if this was helpful, if you guys learned anything, if you guys have any questions, what your thoughts on this strategy are, and I'd love to chat with you guys down there. Let's remember to be a bit better every single day, and until next time.